Welcome to another edition of Laugh, Lend and Eat the podcast, with your host Fobby Nogme. Fobby is the National Sales Manager for First Option Mortgage, as well as a writer for several mortgage magazines. Brian Vieaux, President of FinLocker, joins Fobby on this episode. Brian shares his insight on how technology is changing the mortgage industry, and what the mortgage lender can do to make sure they get their share of the mortgage business. Sit back and enjoy the show.
All right, everybody, welcome back to another edition of Laugh, Lend, and Eat the podcast. And hope everybody's doing well. I know we got a lot of freezing temperatures out there. And speaking of freezing temperatures, we have Brian Vieaux of FinLocker coming in from Michigan, if I remember right, Brian, right?
That's right. It's definitely freezing up here. So we're happy to share our weather with the rest of the country.
Yeah, it's like one of the few times that Texas doesn't look so bad right now to you guys in Michigan, right?
Yeah, right, for sure.
What is the temperature out there right now, Brian?
Oh, we've warmed up quite a bit. I think it's 15 today.
15, nice. That's balmy, man.
That's right.
You know, I always see these guys walk around with shorts up here. I'm in DC Metro, right?
Yeah.
Northern Virginia. And so I see these guys walking around in shorts and it's like 30 degrees outside, right? And I'm like from Pakistan, like anything below 72 is like freezing my butt off.
It's funny. I did a talk about an hour and a half ago with one of our clients. He's in San Diego. And so, you know, I'm here in Michigan, and this talk was for the rest of my company. We do this lunch and learn every month. I call it Bites and Bites since we're kind of in fintech. And the guy that was on is in San Diego, and he's sitting there with a North Face jacket on. And everyone's like, what's up with that?
Yeah, there was one guy who used to be in Miami, and he would put his little cardigan on when it was like 62 degrees outside. I was like, really,
yeah.
Dude, seriously?
That's funny.
Enough about the weather, man. So, you know, you've been in the industry a long time, or at least seems like a long time, right? You got things like 98 or 99 you got in, right?
Yeah, maybe a little earlier, 91.
91, really?
Yeah.
Wow, you got me beat. I thought I had you beat. I got it in 94.
Okay. Yeah, no, I this is the first, my first real job, I'll say, out of college. So, I got in by basically walking my resume around town. I lived in here in Southeast Michigan, and we had just gotten married, and my father-in-law kind of said, there's just one rule here, and that is you need to get my daughter off of my benefits and on your own benefits. And I'm like, what the hell are benefits? I don't even know what benefits are. So I went job hunting, and my number one goal was to find a job with benefits. And that's how I ended up in the mortgage business, believe it or not.
Were you a loan officer to begin with?
So, yeah, I mean, in essence, I started in 91 with a company called Fireman's Fund. And Fireman's Fund was sold right as I was joining the company, and they were at the time the number 2 or number 3 Ginnie Mae servicer. It was a non-bank, we'd call it today, and the job was literally I had a stack of return messages, and there was like 3 points of data on there. There was a name, a phone number, and a number with a percentage next to it. I didn't even know what the heck that meant. And my job was to take those messages, if you will, or callbacks, and sort them highest to lowest based on that number with a percentage, which I later learned that was interest rate.
Nice.
And we were calling, basically I would call people and say, if they were, and these guys were at 12%, 14% on FHA at the time. And our offer was, if we could get you into a 10% for no cost, would you like to talk to a loan officer? That was my job.
Wow.
And I'd smile dial, and the yeses went over here, the no's went in the garbage can, and that was servicing retention in 1991.
Wow. So in other words, you didn't grow up as a kid dying to be a loan officer.
Oh, of course. I studied it. Yeah.
Had pictures of bankers posted up on your wall.
Yeah, exactly. Yeah. Had my HP when I was 11.
Yeah, those were interesting times. So one of the things I saw on your resume when I was getting ready for this is you worked at IndyMac for a brief.
That's
time,
right. Yeah.
In the early 2000s.
Yeah.
And I loved IndyMac. I used to think that was I remember them when they were called Independent National.
Independent National, right? Born in the basement of Countrywide.
Yeah. And then, but IndyMac was a great outfit. Were you in the New Jersey or Pasadena or?
So I joined the company in 2003, and I was part of a team. I led the team that started up a true correspondent lending division.
Okay.
So IndyMac was really, today we'd call them, mini core or non-Del correspondent. And so they really were a broker / kind of mini core shop. And so myself and a few others kind of got recruited in to build out a kind of a traditional agency execution for correspondent lending, delegated, AOT, bulk trade, that whole deal. So my group was in 3 locations: Pasadena, Phoenix, and Atlanta. And then I was lucky enough to be able to stay here in Michigan and ran the platform and just kind of traveled across the country that way.
You just reminded me, I actually wrote a letter one time requesting to have underwriting for my shop. I used to own a company at that time, to have my underwriting taken out of Atlanta back to Pasadena. I said, because the underwriters don't understand how to do loans up here from DC Metro.
Right. Yeah. That's funny. Yeah. It was, so I was there for 5 years, almost to the day. And unfortunately I was there when the FDIC came in and said we were no longer. But it was, I look at that time and, under Mike Perry's leadership, it was by far the most dynamic, engaging environment, entrepreneurial environment. It's a big company, but each department really was able to kind of have their own flavor and be entrepreneurial. And Mike was just a great leader in that respect. He's easily, one of the top 3 mortgage minds that I've ever had the pleasure of working with.
Wow, that's awesome. Yeah, I'm still friends with Linda Bauer.
Oh yeah,
she's actually come on the show, I think, in a few weeks.
No way.
She's a real estate agent now, and so we're doing a realtor panel across country.
Tell her I said hello. She's one of my favorites. Yeah.
She was always a good friend of mine. We stayed friends. I actually called her up in '97. This company I was working at started a subprime division. And no computers back then, right? Just using the manuals and these sheets of formulas how to calculate the rates. And Brian, I literally said this. I said, Linda, I don't know you. I don't know how to use these rates. But if you teach me, I'll make a lot of money for both of us.
Right. There you go. I love it. She was all about that.
And so we went down that road. But and then also you were at, and I'm going through your resume. I'm so sorry about this, but you work with some really cool companies, Flagstar.
Yeah, that's where I was. So I was 27-ish years in mortgage production primarily, and a couple side stints all in mortgage, but mostly in mortgage production, mostly running big production shops, and most recently it was Flagstar, where I ran the third party business, which is where I got to know Kurt from First Option and the First Option company. They were a client of mine at Flagstar, and I've been blessed with being with great companies and working with great leaders at great companies. So when I talk about some of the great mortgage minds or just leadership minds, the CEO of Flagstar, Sandro Danello, is another just wonderful human being, but just a great thought leader. And he was a career banker that had to pivot quickly and really understand mortgage banking. And in less than 12 months from not being in the mortgage business, he could have sat and passed the CMB exam. He's just that intelligent and just understood and got the business quickly.
You also, was Christy Furco there also?
So Christy joined. Christy joined probably 5 years into my tenure there. Yeah, and she's another great friend.
I heard her speak one time at one of the NAMB events a few years ago, and she was just dazzling. I mean, I just thought her insight, her passion, just the way she carried herself was amazing.
As good as she is on stage or in front of people, she's that much better in a one-on-one situation.
Wow.
Just truly one of the most genuine, nicest, but best.
I'll try to get
leaders.
her on the show here.
Yeah.
Although I think it'd be impossible now that she's at the current company that she's at, so we'll see.
Oh, we could probably swing it.
So listen, enough about your resume. I know you're the president at FinLocker. I've been doing a really deep dive on FinLocker because look, I've heard your name. In all fairness, we've never met before. We've never had a conversation prior to this recording. learned a lot about FinLocker, right? I think I could probably go sell FinLocker now for you, by the way.
Let's
If you
do it.
need another salesperson. I think I got it down, but obviously I had a lot of questions also, right? So one of the first question I'd really like to start off with is, it seems like the comparison is made that we have these large retail institutions and they have all these tech products that the smaller institutions just don't have.
Right.
And your guys, FinLocker, you guys are kind of leveling the playing field, if I'm going to just real layman's term, right?
Sure.
So for me, it's like, I'd like to know, like, in your mind, what do you think that the big lenders have that the small lenders don't have right now?
Yeah. Well, so first they have capital and resources to do these kind of things, to build these kind of products, consumer facing products, right? And look at, even the biggest of the banks don't necessarily have the best solutions. So, some are very strong in technology and consumer facing technology, and others, they're woefully behind still. But what they do have is the capital, and they have the manpower to go build stuff for themselves, right? And what we built at FinLocker was this, we built this consumer facing, financial well-being app is probably the best way to describe it. It's a very holistic financial app for consumers. But we built it in a way that is pretty easy to implement. I mean, you can make stuff very difficult and complicated if you want to, but literally, if a lender signs up with FinLocker today, Thursday, by next Thursday, I could have their environment stood up, and they could be engaging consumers into their custom white labeled version of the FinLocker app. So of course, that's no customization and no implementation, but we've made it that easy to set up. And so what we think we've got is a way for, I'll say mid-sized to smaller lenders in financial institutions, although we're working with some larger ones. But
well, I mean, we define mid-size real quick. I mean, a lot of people listening may not understand that word, right? So
yeah, everybody's got it. I would say probably, if we want to talk about it in terms of originations, probably sub, 15 billion a year in originations is probably mid-size. 5 to 15 is probably mid-size, and then the smaller players are sub 5 billion a year, something like that.
Got it. Okay, that's fair.
It all depends on how you think.
I see different statistics, and I think Scotsman's guy has one thing, and then recently some other survey had another thing based on employees.
Yeah.
So you never know. So I want to make sure the audience understands where FinLocker could really benefit them if they're that category. Yeah,
what I would say is we have mortgage brokers who are clients that are using us, and those are the smallest of the small local, hyper local, originators, and we have publicly traded, national financial institutions, banks that are clients. So what we do feel our sweet spot is that mid-size.
Got it. So give me one product in your mind, because I saw your website, right, or your app. Actually, I downloaded it on my phone.
Nice.
Right. So now you got my information, by the way. Keep it secret.
We can't see it. We can only see it when you decide to show it to us.
Thank you. Like one product that I think, let's say a broker, let's use a broker because I like that. It's a very small shop, maybe a couple of guys, and they're doing, 30, 40 units a month, not a whole lot, but hey, it's their livelihood.
Right.
What would one product that would make the broker's life easier, I guess, that FinLocker could offer them today?
Yeah, so that's a great question because there's clearly products out there, technology that's focused on efficiencies and streamlining processes. We're not necessarily in that space, although there's things that we do as a byproduct that create efficiencies and create streamline. The way I think about the benefit to a local originator, whether it's a mortgage broker or a loan officer who's within a shop, our product becomes an extension of that originator. And what I mean is, if you're prospecting at the top of the sales funnel and you're focused on filling your funnel with prospective first-time home buyers, you can either conduct home buyer classes and education and do webinars and seminars and this, that, and the other thing, which are all great ideas to do to build your funnel. or you can use a tool like FinLocker, which becomes an extension of you. It's your brand, it's your logo. You're the loan officer connected to the consumer in that locker, and you can give that tool to the consumer for free. And the consumer then can use that tool to monitor their credit and learn about how to improve their credit, enroll their financial accounts and create budgets and goals for saving, use the mortgage readiness assessment to get a gauge on where they stand. And so it becomes a way to kind of connect with a wider group of folks and help them groom and prepare for an event. And let's just say the event's buying a home, right?
Yeah.
So that's kind of that's top of the funnel. The other place where it benefits the loan officer is we're not a one and done transactional app, right? So once the app's on the consumer's phone, the tools and features and function of the app continue to provide benefit to that consumer beyond a mortgage closing. So now it becomes another way to stay meaningfully connected for a customer for life experience, to keep your brand in front of that consumer.
So the loan officer basically, I mean, as long as I don't delete this app from my phone.
Yep.
Which I normally don't.
I know.
I got pizza places in Florida that I go into one time because I can order online, you know what I mean? So as long as the consumer keeps the app on the phone, will they be getting messages or touches from the loan officer periodically? And
that's exactly right.
Nice.
So the way to think about the app, and we're actually going through a relaunch of our mobile app. So we're about 11 weeks into a 6-month project. In early May, we'll launch what we're calling FinLocker 2.0. And there's 3 pillars of this relaunch that we're working on. One is, UI, UX, which is always something you've got to have, your eye on. So we're working on improving gamification, and just improving the overall user experience, as well as exposing features and functionality for the user. So that's kind of one of the cores of the rebuild. The second pillar is this concept of persona. So we're building an infrastructure that is based off of a persona of a user. So as the user is invited to the app and they start to sign up and fill out their profile, we start to categorize them into a specific persona. And then as they go deeper in their profile, and we ask them questions about their goals and objectives, those become attributes of the persona. And then we create a very dynamic custom journey for that user based on their persona and their objectives. And then we have this layer of engagement that is doing what you described. It's continually reaching out to the user saying, hey, you're halfway to your goal for saving for a down payment, or, it's time to, you're a first-time home buyer. You've loaded your locker, 2 months ago with documents to be ready to apply when you are mortgage ready. And it's time to update your most recent pay stubs. Do you want to download and upload those to your locker now? So just continually reaching out in that regard.
You know Sue Woodard, right? You
Oh, yeah.
Sue, right?
Yeah.
She was on the show a few months ago, and she said something you're just reminding me of this, because it's almost like a lot of my tech friends or guests are kind of heading down the same highway, right? I'm hearing a bunch, and so I get the benefit of being having a conversation with you all, right? And she was talking about it, Fobby, it's not artificial intelligence anymore, it's artificial intuition.
Yes,
right?
I love it.
And
so you're gonna
describing
see
is the same thing now.
You're gonna see some news around Sue and her group and FinLocker and our group at some point. But yeah, that's exactly right. And what's cool about what we built is it's all based around direct source data, the consumer's direct source data. So yes, we collect some information directly from them as they complete their profile, but then when they enroll their credit, add financial accounts, every day we have a dynamic, fresh look at their entire financial picture. And so when you think about the journeys and the engagement of the platform, journeys will dynamically change as their data changes, especially if they've set goals and objectives and they've met those goals and objectives. They leave that journey and they're on to the next one.
Wow. Yeah. So, I mean, you guys partnered up with TransUnion about a year ago, right?
Yes. Is
that how you guys are getting the credit information?
So our partner for the credit products is TransUnion. What's cool about our relationship with TransUnion is they invested in FinLocker. So they're a significant investor in our company. B, we've executed a commercial agreement where they actually are buying our product and using our product with some of their B2B mortgage customers that they work with.
Okay.
And then probably the coolest thing that I think is super relevant for the audience, especially those looking to fill next year's first-time homebuyer pipeline. TransUnion is one of the bureaus, right? And they know more about you and I than we know about ourselves.
Yeah, that's what scared me.
So they have all this vast credit data that they can tap into, and they have some really smart people there. They have a group of data scientists. They built sophisticated algorithms that go look at the data. And let's just say First Option, as an example, said, "Hey, Brian, I want to partner with FinLocker and TransUnion and identify consumers who are likely first-time home buyers in the next 6 to 18 months in these geographies, these 5 states that we want to bring into our funnel." TU goes out, kind of runs their model, their algorithms, brings you back 50,000, 100,000, 1 million records of data, right? Now, we're not telling you these are all guaranteed going to buy a house, but they're very likely to based on the data that TU has analyzed.
Mm-hmm.
And these are way up the sales funnel. So there's no triggers happening. No one's raising their hand saying, "I'm buying a house." And how do I know that? Because you had a tri-merge credit bureau. These are predictive leads that then you market them to get into your FinLocker environment. And then the locker grooms and prepares them for mortgage readiness under your logo.
At what point do we cross the line of privacy rights?
Yeah, it's it's blurred, right? It's a very
right. I mean, because I mean, you're talking about I haven't pulled my credit report. I've never had, you know what I mean? And then all of a sudden, First Option starts saying, "Hey, Fob, are you thinking about maybe upgrading your home?
Right.
I heard you got a new dog."
Yeah. I mean, there's a fine line. There's, you have to, in the example that I described, you have to be in a position to make a firm offer of credit. So, but that's just, that's part of the marketing program.
Right.
But you're right. It's a blurred line. And I think, the way we think about it at FinLocker is, we've built this app that, if you want to go look at the mint.coms and the NerdWallets and the Credit Karmas and Credit Sesames, et cetera, we have a lot of the similar features and functionality. I think we go a little deeper and a little wider with the tools. The key difference in our mind anyway, is that when a consumer comes into FinLocker, they're coming into the First Option instance of FinLocker, and it's a one-to-one relationship with the consumer and the financial institution.
Right. That's a good point. That's a great
point.
Point.
Where Mint is basically going to sell you or I as a lead to another financial institution.
Why does everybody put the locker after their company's name? Whenever I see somebody team up with you,
I know
it's XYZ Locker, it's BYD with Locker.
we see Locker, Vault. I don't know if you saw what the guys at Vetted VA did. They are actually pretty cool. They call are you familiar with Chris Griffith and the Vetted VA guys?
I know Chris. Yeah. Uh-huh.
So they work with veterans. That's their constituency, and they call it the Vetted VA Go Bag. So nice. in military parlance, you always have your Go Bag packed, right?
Yeah, that's cool. That's very cool. Yep. I think I would call this something like maybe First Option U-Haul.
There you
like you fill the locker up, I'll take it when you're ready to move.
Hey, we're up for that.
So let's dive into this a little bit more. Because look, I mean, I saw a show of yours from last year, or you were on a show. I'm not sorry, you don't have a show. By the way, if you ever decide to have a show, you got to call it The View.
Yeah, I write a piece for Jason Frazier's Mortgage X newsletter, and it's called The View.
Yeah, you're right above me. I'm below you.
Yeah.
I forgot. I think mine is Beyond the Numbers, but yes, I saw that's where it was in my head. So 2020, we walked into 2020 with this pandemic. We walked into it like also the money got sucked out of the market. There was panic. There was question to you. I mean, did we overreact as an industry about 11 and a half months ago?
I think we did.
Yeah.
I mean, they're clearly, well, I don't know if you could say it was an overreaction, because this was literally a once every 100-year event, right?
Okay.
And so in the U.S., we never had this type of an event when we've also had this kind of economic or financial environment or infrastructure. And I think, it's easy now to say, yes, it was an overreaction. The really good news is it was really compressed into about a 5-week period of time.
Yeah, that's fair. That's fair. Yeah.
I was actually, thinking I was pretty smart at that point for getting out of the mortgage business directly. Until the last 10 months happened, and I've seen the crazy numbers people have been putting up.
Yeah, I got on about last August. I started telling everybody, no more coming on my show and talk about the record number that you just hit.
Right.
Like if you're not hitting record numbers this year, you're never going to hit them.
That's right. That's right.
My dog can close 7 loans a month right now. I mean, that's
right on.
So it was kind of overall as an industry, though, we fared well.
Yeah.
A lot of it had to do with products like FinLocker kind of offers, where consumers knew they were ready to buy a house. I saw a lot of prepared buyers coming.
Yes.
I'm not on the front end anymore on the sales side, but I see my market leaders and their loan officers and so on, and they were just. It wasn't just refis; it was a lot of purchases going on.
Yep.
And did you guys, see an uptick at all? Any kind of benefit? More people signing up on FinLocker?
We do. There was from the consumer perspective, what we started to see in the, call it May, June timeframe last year, was consumer adoption really kind of spike up. In other words, as our clients were inviting their prospects and customers into the app environment, we saw a higher percentage of kind of uptake or acceptance rate, again, that May, June. And what that kind of signaled to us was there was this pivot kind of happening, and the pandemic accelerated it, where, even our grandparents had to figure out how to do mobile banking, right?
Yeah, or a Zoom call with the kids, FaceTime.
Yeah, exactly. I mean, the pandemic definitely accelerated consumer acceptance of technology, especially mobile technology and mobile financial technology, even more so. I think what's going to be fascinating, frankly, is 18 months from now, looking at that next 2 or 3 years of mortgage origination, and how much real face-to-face will happen, right?
Yeah.
I mean, let's not kid ourselves. The distributed retail loan officer model, great model. I think the value is immense. There is immense value in the knowledge that local professionals bring to the equation.
Absolutely.
But even pre-pandemic, a good loan officer, even a great loan officer, would be lying to you if they said that they were meeting face-to-face with more than 50% of their borrowers. We just have evolved greatly. And I think we're even, we're probably pushing, well, today we're 95% we're doing digitally just out of necessity.
I mean, Jason actually penned a letter in that Mortgage X letter that we write in, where he's talking about the Zillow, right? Yeah. And the obviously the amazing lead that Zillow has. And I know Barry Habib, he was talking about, I forgot the guy's name right now, Kent Richard something, that runs Zillow, was previously running Travelocity or Expedia, right?
Yeah, I think so, yeah.
And Expedia, and I remember reading an article with some travel agents, I told this to Barry one time, where they were glad, they were hyping the fact that they received 24% of the online business that past year.
Yeah.
And I'm thinking, hold on, 24%, that means 76% was done by some digital company.
Right.
Not that local. And so are we experiencing, or I mean, obviously, look, I think it's a foregone conclusion that we're going into that, timeline that you're seeing, because look, you're on the cutting edge of technology, right?
Yeah.
Timeline, is there a sunset? I mean, is there like a couple of years? Is it, Fob, you know what, by the end of 2025, if you're not digitally savvy, you're probably not going to survive?
Yeah, I think if you're not there by end of 2021, you're done. I mean, that's
yeah.
Because if you're not already at least trying to figure out how to get somewhere into that space, things are moving so fast, and what I'm amazed at is how much capital is coming into our industry around technology, around fintech. And so that's a bellwether right there that just tells you if you're not investing in your business right now, it's going to be a rough ending, I think.
Yeah, no, I mean, I looked at the travel industry and really, because quite honestly, I mean, I started using more and more online travel. I don't know, like maybe '07,
Yeah.
'06,
Yeah.
even sooner. I can't really remember the date that it happened. It was just to get the cheapest price,
Right.
even though there was a family friend who had a travel agency that I had known since I was 4 years old. You know what I mean?
Yeah.
But his rates were always higher. And I just wonder at some point in the mortgage business if that's what we come down to, where the other part, real quick to this, is also with like Allstate insurance. I named them only because it's top of my head, right?
Sure.
No matter which agent you call, you always get the same price.
Yeah.
If I have a 2016 whatever Toyota, I'm going to get the same price from no one's going to be higher than that one price.
Right.
I kind of foresee that happening in our industry also.
Yeah, I think we're getting there faster with data, with as much data as available. And FinLocker is a good example of that, where we're not too far off, where we as consumers will be walking around with all of our data ready to go for any kind of transaction, right?
Mm-hmm.
And now it's just a matter of saying, okay, I've got my locker, my FinLocker is ready, and I'm buying my Ford Explorer. I'm ready to submit my application for my lease or my auto loan. Will you accept my locker? And we can replace locker with my form-free passport, right? Because Brent has got a great product.
What I was thinking. You mean you get the bio data for your financial bio data?
Yep, that's where we're going. We're rapidly getting to a place where consumers are in control of their data and empowered to leverage their data to their benefit. And part of their benefit is going to be ease and security, but a big part of it's going to be commoditizing the product and the price and getting the best possible combination of price and product.
You said the S word, so let's go. That was a question I had. So security.
Yes.
FinLocker, you guys are holding all my information this morning. So I'm trusting you guys that no one's going to invade you guys. And
right on.
You know what I mean? And now, obviously, I got some other stuff to make sure if something happens, I'm protected, all that, right? Most people may not have that. What are you guys doing without going into details, right? But
yeah,
how are you guys comfortable holding all this data in your lockers?
So there's the first thing to say is that FinLocker as an entity, we don't have the data. We don't hold the data. So we subscribe, we're a client of Microsoft, and we use the Microsoft tech stack, including their Azure cloud. So all of the data is secured in the Microsoft Azure cloud. That's kind of one thing. The only time data is exposed to FinLocker is when the consumer expressly consents to use their data. And in the case of a mortgage, they can start a mortgage application from our product. And when they go through the consent process, we then start to aggregate their data from the cloud into a file that the consumer then can securely share to their lender through the app. So it's pretty important to know that the data itself is stored in the Azure cloud. And then the sharing of data is all based on consumer consent, and it's consumer consent each time they want to share that data. So very, very secure in that respect. Microsoft puts us through all kinds of scrutiny and audits. We're audited by folks like Fannie and Freddie as well. And then, we have banks who are clients, and so they put us through pretty tough vendor approval and monitoring. So we're very focused on the security. That's the biggest, if you think about it, the biggest risk to our brand is a security issue. And so it's what we think about all the time.
I think, the more we rely, just like kind of like we were talking about privacy rights and everything, but the more we rely and have convenience with our phones and putting all of our stuff on this one phone, security is just, and we're hearing these news every day about more and more cyber crimes and this, It's just like, I remember at one point, I have a cousin of mine, he's a cybersecurity expert here in DC. and he told me, "Hey, listen, it's already over. Don't worry about it. Someone already has your information."
Oh yeah. Yeah.
You know, so I was like, "Oh my God." He goes, "The only way you can ever do that is just totally get off the grid,
Yeah.
start using cash again." I can't go back to that life.
No, I can honestly say that the last time I touched paper money, it's probably been a year now.
Especially with the pandemic, right?
Yeah.
Like, who do
I
someone
don't
asked me
leave
for
my
my credit
house.
card. Someone asked me for my credit card number the other day, like a week ago. I couldn't figure out where my wallet was because on on Google or whatever, I keep all my credit cards. So if I had
Right.
to pay the online,
Yeah.
and other than Google, there's Amazon.
Yeah. It's amazing.
So let's talk about homeowners and financial issues facing them right now. As we're look, rates are ticking up. We knew
Yep.
this was going to happen. There's a $1.9 trillion bailout, which I look at it as deficit, but it's needed, or whatever side that you think it is, but whatever. So rates are going to have pressure on them in this entire year.
Right.
They got to go somewhere, and it looks like it's going to go up. So as a homeowner, other than the rates, what other financial issues are they facing right now?
So these are you're talking about kind of current homeowners who
Potential homeowners. Let's
yeah.
say potential homeowners.
Yeah, I think I think the biggest risk that they face is employment, right? And so just depending on the sector that they're in, again, we've been blessed to not have been, our industry has not been impacted negatively by COVID. In fact, one could say the only negative impact to our industry is there's too many loans and not enough capacity to handle them, right? That's a real challenge. But other industries aren't as lucky, and there have been significant number of people that have been impacted. So I think there will be this population of impacted consumers, and probably consumers who otherwise would have been ready to buy a home in 21 and 22 that they might be extended another 18 months or 24 months until they become ready, depending on how long they were out of work and what that impact looks like. I think the homeowners, what I'm really watching and I guess concerned with is what happens once this, with this forbearance window finally closes, right?
Yeah.
And will we see a flood of, loan modifications that then trickle into or maybe turn into a wave of defaults and foreclosures?
Yeah.
The reality is I think we're now into May or June with the kind of forbearance extension. And so if that's the case, you're probably not even seeing real default, coming until 2022. And then if you layer on top, most states have, 12 months of process for foreclosure. You're really not even talking about 2023 until the first wave of properties would hit the market. And the biggest difference as we sit here today from the last crisis was that crisis was brought on by a liquidity event that then crushed property values. You had we had some bad financial instruments that were deployed as well.
Sure.
This was not started by a financial crisis and a liquidity crunch. It was, it's a health event that presumably will be behind us at some point. And so all we can kind of hope for, I guess, is that if we don't see property values plummet as a result, then maybe the foreclosure impact won't be as high because more people will have some equity to kind of exit gracefully from their mortgage in their home versus just having to turn the keys in.
Yeah, I've always believed that if the values stay up, then more people will more likely sell the property than let the bank take it back.
That's right. Yeah,
if you got 10%, 15% equity, you're not going to let that go.
Yeah, you're gonna do the math.
120%. Yeah.
Yeah. Now, we likely, because if you remember the crisis brought this concept of strategic defaults. No one ever talked about strategic defaults until the last crisis, right?
Right.
And those were just people gaming the system.
Yeah.
Will we see that again? Probably. That's probably going to be dependent on how much equity they really have in the property. I think if there's a significant amount of equity, let's say 50K or more, I don't know that strategic defaults is the best, going to be the best consumer experience there. And so it's probably going to be those tighter equity positions that people may just say, look, if I can stay in this home for 12 or 15 months, whatever the foreclosure period is, and not make a payment, then I'm just going to bank that $1,500 a month in payment and move on.
I've always said that the greatest thing that we received out of that last 2008 mortgage collapse was obviously a little bit more realistic and appraised values.
Yeah.
Where appraisals and I don't know the right word. I know there's a form out there or some law out there that protects appraisals and that kind of stuff, right? But I just feel like they have much more concrete values that are being given, and they're just not kind of like, hey, the loan officer said he's not going to pay me if I don't give him X value.
Yeah, but a big piece of the puzzle back in the crisis was it wasn't the primary home purchaser that really caused the big issue. It was the speculators, the investors that could get in and buy a home with no money down, with a no doc CISA type product. And they had no skin in the game to begin with. And so the first sign of trouble, it was just a financial trade for them to say, here you go, lender, here's the keys, I'm out.
Yeah, what's funny is, and I'm going to have a couple of realtors on here in a few weeks, so I'm going to say something that's probably going to get me in trouble with them. But in the 2008 meltdown, I never saw one article or story ever talk negatively about the real estate agent.
Right.
And I know I was originating back in those days. You know what I mean?
Yeah.
Now, I always remember this one agent who brought in a client who had 4 contracts on 4 different properties in the same new development and wanted me to do each property owner occupied.
Yeah. Oh, yeah.
Really? I'm like, seriously? I mean, what benefit does my company get for doing that?
Yeah, I think, I also think we are a more sophisticated industry in 2021 than we were in 07, 08, 09 in terms of our ability to understand big data. And that's only going to help us going forward. I think I have a hard time believing today that, a lender, the GSEs, if you or I were going to go out and buy a new primary residence, they could flag that pretty quickly and say, whoa, wait a minute. What about your house in Novi, Brian? What's going on there?
Yeah, absolutely. Now, recently, you guys, I think in the last 6 months, you guys just developed a relationship with Marsha Griffin's company, Home Free.
Yes.
Right.
Yeah.
Now, it was a little unusual for me to see that, right? Because I've always thought of that organization. I think it's an organization, right?
The nonprofit. Yep.
So, I mean, how is that going to benefit their base? FinLocker?
So, we have a couple interesting non-lender, non-financial institution relationships. Home Free USA is one, and I think within Home Free USA we have 15 or 20 of their affiliate nonprofits that are working with us. And then we also work with a couple nonprofit housing counseling agencies, credit coaches. The value that they're seeing, first of all, the consumers that they are helping. This is where I talk about high tech. So our app melded with high touch. That local counselor, the Home Free USA nonprofits and their counselors who engage one-on-one with consumers. When we can bring in technology with the high touch, we allow that counselor to scale and touch more consumers. And it really, here's where it comes into play. From a housing counseling perspective, a consumer who's working with a housing counselor or a credit counselor goes through a pretty deep budgeting exercise. And I always paint the picture of the consumer coming in with their shoebox of receipts and statements. It's not quite that bad.
I'm that client. Don't laugh.
It's not quite that bad, but they use spreadsheets. They interview the consumer and they plug stuff into a spreadsheet. Well, with a product like FinLocker, if you're my counselor and I'm working with you, you would say, hey, Brian, here's this app. Here's my app. Sign in. Let's go in together and set up your locker. And then when I've enrolled my credit, my financial accounts, et cetera, all the data from my accounts are there, the transactional data. So then we created a detailed budget that mirrors the HUD approved housing counseling budget.
Okay.
And what we're enabling the consumer to do, once they've set up their app, once their budget is activated, they can now digitally share that budget with their coach, their counselor. So
Wow.
we've probably just taken out at least an hour upfront in that engagement. But then when they meet monthly or however often they coach, that data is up to date and refreshed every time.
Are you seeing an uptick of people working towards home ownership with Home Free now?
Yeah, there's
awesome.
there's a lot. I was surprised at how many consumers are going to folks like Home Free and other nonprofits direct without a lender first, or without a real estate professional. They're, these local nonprofits are just wonderful assets to the community, and so the consumers are getting there and finding them and working with them. And what we're working on is, we've got a couple dozen, maybe 3 dozen clients today, lender clients, and ultimately we want to find a way to match consumers who are becoming mortgage ready with one of our nonprofits with lender clients, and be able to seamlessly share data to enable a mortgage application.
Yeah. That one caught my attention because we're both in the DC Metro.
Yeah.
So I was like, hey, I didn't know about that one. So that's pretty interesting.
There's another, another way to think about it. And there was just an article that I just literally read like 10 minutes before you and I started. It was talking about the mortgage declination rate for minorities versus non-minorities. And it's crazy, astounding how that is. And my immediate thought was, FinLocker doesn't see color. We just see data. And so we built a mortgage readiness assessment that just analyzes data. And part of me wonders if that type of solution is a way to help solve for this massive disparity in the mortgage declination rate. I don't think we solve for it all, but I think we can help.
I think every little piece helps, Brian. You know what I mean? I think you'll never be able to stop what I call human biases.
Right.
You can't help that, right?
Yeah.
But I think everything helps, and the more our focus comes because of these articles and because of personal stories that we may know about,
right,
the more I think we can lend a hand where there's needed.
And that's really our mission. You'll hear Henry Kaysen. Henry joined us from Fannie Mae as our CEO, and he's very mission oriented, and we're all about building cool tech. But at the end of the day, we want to help people be financially well. That's really what we do. And we have a very focused effort on helping the underserved segment of our population. Kind of, I don't know that in a perfect world, we think our technology could help level the playing field, but I go back to, we only see data, we don't see color. And I think there is an element of, if we can help nonprofits and folks that are really working that segment, with arming them with better technology to enable and empower the consumers they engage with, maybe we can help a little bit in improving that.
Absolutely. I mean, several years ago at another lender that I was at, we really led a thing to drop the credit scores. When the credit scores, I think in the 2012, 2013, it was at like 640, 660. And I attributed that same, like, it was basically like you're redlining.
Yeah.
It's not to say that every minority had a score that was low, but the majority of minorities did have scores below 620, 600.
Yeah.
And by not offering them credit, we were in essence doing what I call labeled credit redlining.
That's right.
And we were able to get the scores down low at this one company and really made an impact. To where, I'm not going to say I spearheaded that, but I definitely was part of the voices that I needed to be heard at that point.
For sure. No, we love that. That's kind of speaks to us and our mission with our product.
Yeah. So let's fast forward a little bit post-pandemic.
Yeah.
Because you said something that was really cool. You had the same feeling I did. You looked at your Delta app, you saw it was empty, like nowhere to go, right? I had the same effect with my American Airlines. Like I looked at it one day, there was like absolutely no.
Yeah.
Because that's the only way I used to keep track of my schedule before.
Same.
Both those, right?
Yeah.
When do you see some kind of normalcy come back to business travel where, we're kind of comfortable going back and forth, and do we want to do it?
Yeah.
That's the other bigger looming. Do I really want to go back to that life?
So here, I was a road warrior for 2 decades. And so it became it became my life. And when I was in my office for a week at a time, I was going stir crazy. I think it's gonna. I don't think we ever get back to. If you want to say 2019 was called, if you want to call 2019 as normal in terms of business travel, honestly, I don't know that we ever get back to that. And it's, I don't think it's because of a fear of flying or this or that. I think it's we've all had to adapt, not just in our industry. Every industry's had to adapt. And if I had to be truthfully honest here with myself, I've been way more productive being sitting here at this desk in my house for the last freaking 11 months, 12 hours a day, 7 days, whatever. But when you're traveling there, and I look forward, my biggest thing that I look forward to on traveling was the alone, quiet time on an airplane by myself. No texts, no phones, all that. But I truthfully, we are so much more productive, I think, as people, and we've learned how to adapt. Do we need to be face to face? Absolutely. That's in our human nature. But do I need to attend 30 conferences in the mortgage industry in a year? I could probably get away with a half a dozen to a dozen, and that would be plenty, right?
And do the other virtually, because I don't think Zoom or WebEx or other stuff is going anywhere. I think it's going to be integrated into our lifestyles.
Yeah.
Where if you don't want to travel, you know what I mean, and spend 3 days in Las Vegas and eat lousy food.
Right. For me personally, and for FinLocker, what we found, I was in panic mode when the thing hit, because we were just kind of starting to get momentum, and it was a lot of FaceTime and just conference rooms, demos, blah, 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 blah. The quality of our demos is 20x better over Zoom, over Teams than it is.
Wow.
I mean, just think about the headache you have to go when you get in a conference room and you've got to set up all the contraptions.
Right. If something doesn't go right.
Hope you can get on as the guest Wi-Fi.
Right?
And
I used to have my iPad that I would do like a presentation on, and I would look for somewhere to plug it in.
Yeah.
And God forbid they didn't have the right adapter.
Right. I mean, I do miss not being able to look across the table from somebody and kind of read signals, but the quality of our demos is just way better in this environment. So I don't see us. I think we are going to lean into this in a big way at FinLocker.
Good for you guys. All right, man. Listen, we're going to wrap things up, but I need to ask you one thing that I think is close to your heart. I've been seeing you lose weight physically on these pictures. And I can see here also you're losing weight. Is this related to your love of the Downtown Boxing Club and why you're donating to it?
Yeah, I love it. It's not at all, because a lot of people, when they hear about the Downtown Boxing Gym, which is it's a Detroit inner city after school youth education program. I say we because I'd love to be associated with it. I'm on the board there. They and our founder, Kali, he uses boxing as the hook, right? Nice. And so the kids that he serves are in they're in dire, desperate need of help educationally. And Kali himself would tell you that when he was 18, he literally thought his path by the age of 22 was either jail or death. That was it.
Oh, wow.
Because all of his friends and family, that's what happened to them.
Yeah.
He committed to this cause, and he helps kids that are in trouble educationally, and our program brings them back. We've got 100% graduation rate over the last 10 years, and he uses boxing as the hook. And I love the story, because he'll say, if Johnny's telling his neighborhood friends that he's after school, he's got to go to get tutored, he's probably going to get his ass kicked. Right. But if Johnny says, hey, I'm going to the gym, all his buddies are like, what? You're going to box? That's so cool. So boxing's the hook. Boxing is about 5% of what happens on a day-to-day basis in that facility. It's all about preparing these kids for higher education or life after school.
So if somebody wants to donate, how can they donate to that, Brian? I know.
Yeah. So probably the best way is to email me, and I'll forward a link to our board, our giving page. But if you want to check it out, it's downtownboxinggym.org. And then my email is brian.vieaux, V as in Victor, IEAUX @finlocker.com.
Awesome.
I
And
appreciate
obviously,
you bringing
look,
that up.
it's much easier to find all of us on LinkedIn and Facebook.
And I'm on LinkedIn. Yeah.
And I think I'm just gonna. Are you on TikTok?
I think I have it on my phone, but I just don't use it.
Dude, I bugged out of Clubhouse. I couldn't do Clubhouse.
I turned off
Too much.
Clubhouse. It was too many notifications. Yeah.
That was way too much for me. So anyway, listen, looks like my phone is ringing. That's weird. I thought I muted it. Apologize for that.
No worries.
So thank you so much for coming on.
Yeah,
Hope
thanks for having me.
Stay warm in Michigan.
You
And
too.
I swear to brother, I wish you much success with FinLocker, and I know you guys are going to knock out the parks. Thank
Well, I
you so much.
appreciate it.
Okay, Ron?
Yeah. Take
Have a
care.
great
Thank
day.
you.
We hope you enjoyed this episode of Laugh, Lend and Eat, the podcast. Once again, thank you to our sponsors, First Option Mortgage and One Good One Staffing Services. We have enjoyed all the comments we have been receiving. Please keep them coming. To be notified of any updates, please be sure to subscribe to Laugh, Lend and Eat on the listening platform of your choice. Thank you for listening and have a great day.